Hello and good evening, everyone. I am Mangesh Deshmukh from the Corporate Communications team, and on behalf of CareEdge, I welcome you to today's discussion on Unravelling the Microfinance Landscape, Trends, Challenges, and Potential, and sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today, Mr. Aleem Remtula, Partner, Head of Private Equity, Developing World Markets, Mr. Chandramouli Vimuru, General Manager, SIDBI, Mr. Manoj Kumar Nambiar, Managing Director and Board Member, Arohan Financial Service Limited, Mr. Vineet Chattree, Managing Director, Svatantra Microfin Private Limited. This session will be moderated by Sanjay Agarwal, Senior Director at CareEdge Ratings. We will commence this session with a presentation by Neha Kadiyan, Associate Director at CareEdge Ratings. This will be followed by a panel discussion and a Q&A session. In case of queries, participants are requested to key in your panel. We will take up your queries during our panel discussion session. Now, may I invite Neha to make her presentation?
Thanks, Mangesh. Good evening, everyone. I am Neha Kadiyan, Associate Director at CareEdge, and today I'll discuss about the current ongoing trends in the NBFC MFI space and outlook going forward. Key takeaways. The key takeaways from this presentation are RBI's new regulatory framework has harmonized the regulation across lenders, enhancing the flexibility for the industry. This, along with the improving macroeconomic environment, has led to improved financial health for the sector, as reflected from strong growth in assets under management and improving profitability profile. During financial year 23, investors have shown their confidence in the industry by investing substantial quantum of primary equity in the NBFC MFI space. Also, post-COVID, we have observed an evolving business model with improving digitalization, shift towards individual lending, and rise in co-lending arrangements. However, there are few risks which needs to be constantly monitored, such as increasing indebtedness at the customer level, rising ticket size, high inflation, and vulnerability of the sector to external shocks. Profitability expected to improve. The NBFC MFI industry has benefited from the harmonization of regulations by the Reserve Bank of India. NBFC MFIs can now engage in risk-based pricing, which in turn has boosted their net interest margins and led to improvement in return on total assets. Credit costs have also declined from their peak witnessed in financial year 21, but still remain higher than the pre-COVID levels, with the portion of the restructured book slipping into NPA. Further, with improving collection efficiency, credit cost is expected to further go down in the current financial year. Also, now NBFC MFIs have begun to adapt to new technology trends for faster loan origination, efficient customer services, and cash-based transactions. This has improved the overall efficiency and productivity of the microfinance institutions. This slide explains how rise in margins has led to improvement in ROTA. The graph on the left-hand side shows the rise in net interest margins in financial year 23 with the implementation of risk-based pricing, as well as with lower interest income reversals on account of improvement in the asset quality. While NIMs in financial year 23 are higher as compared to previous 2 years, they are still relatively low as compared to pre-COVID level. However, as the full impact of the revised regulations is yet to be seen, we expect the NIMs to rise going forward in financial year 24. The graph on the right-hand side reflects credit cost and operating expenses trend over the last few years. Operating expenses to average assets ratio increased in financial year 23, driven by rapid branch expansion, increasing technological advancement, as well as increased compliance with the revised RBI regulatory framework. However, going forward, we expect the rate of rise in operating expenses to moderate, with efficiencies kicking in. Coming to credit cost, with improving macroeconomic environment, the credit cost to average assets ratio is on a declining trend, and we expect it to further reduce to around 2.5% of average assets in financial year 24. However, it will continue to remain higher than the pre-COVID level. Overall, going forward, profitability is expected to improve further with higher margins and reduced credit cost. And CareRating expect the industry to report return on total assets of around 3.8% in financial year 24. Growth drivers remain strong. Despite the challenges posed by the COVID pandemic, the NBFC MFI industry has been able to come back on the recovery path. Improving macroeconomic environment and RBI's new regulations have given the industry the much needed push. Further, after a subdued financial year 21 and financial year 22, investors have also shown their support by investing close to 3,000 crore of primary equity in the industry. Having said that, considering the current global outlook and various macroeconomic factors, ability of the NBFC MFI industry to consistently raise capital to support their future growth plans will be a key monitorable. NBFC MFI is expected to grow at 28% year-on-year in financial year 24. The NBFC MFI industry experienced a slowdown in growth in financial year 21 and financial year 22 due to the COVID pandemic. However, growth rebounded in financial year 23, with the industry reporting a strong growth at 37% year-on-year, supported by improved disbursements. This growth momentum is expected to continue, with CareRatings projecting a healthy loan growth of around 28% year-on-year for financial year 24. Bihar, Tamil Nadu, Uttar Pradesh, Karnataka, and West Bengal remain the top 5 states in terms of assets under management, with Bihar leading the sector with around 15% market share as on December 31, 2022. In terms of product profile, joint liability group loans currently dominate the portfolio mix. However, with the new RBI guidelines, we are increasingly witnessing a shift towards individual lending. Surpassing banks in the microfinancing landscape. The microfinance industry has experienced a shift in market share, with NBFC MFIs overtaking banks for the first time in the last 4 years. While banks held a dominant position with market share of 40% or more during the COVID period, subdued growth led to decline in market share from 40% in financial year 22 to 34% in financial year 23. Share of NBFC MFI, on the other hand, increased from 35% in financial year 22 to 40% in financial year 23. Gearing expected to remain range-bound. During the pandemic, subdued profitability, along with lack of substantial equity infusion into the NBFC MFI space, led to rise in gearing to around 3.7 times during financial year 21 and financial year 22. This was despite the fact that the loan book growth remained relatively muted during this period. Financial year 23, on the other hand, witnessed a sharp rise in disbursements. However, driven by improving profitability profile, leading to healthy internal accruals, and investors' renewed confidence in the industry, gearing profile remained largely stable. As can be seen from the graph on the right side, the NBFC MFI industry raised around 3,000 crore of primary equity in financial year 23, compared to around 1,500 crore in financial year 22 and 1,400 crore in financial year 21. While larger NBFC MFIs were able to raise equity from initial public offerings, as well as from existing and new investors, mid and small-sized NBFC MFIs were more dependent on bank funding to meet their growth requirements. Overall, we expect the gearing level of the NBFC MFI sector to remain range-bound at around 4.1x over the next 12 months. Considering the nature of the asset class, any significant rise in gearing from the 4x level remains a key rating monitorable. Improving asset quality. Post the aggravating impact of the COVID pandemic, on the income profile of low-income groups, asset quality stress spiked for the sector. The gross non-performing asset ratio peaked at around 6.2% in financial year 22 compared to 2.1% in financial year 20. However, with substantial write-offs and better collection efficiency, supported by an improving macroeconomic environment, an improving NPA trend is clearly visible. Further, as seen from the right side graph, the restructured book also declined from 9.5% in financial year 22 to around 1.6% in financial year 23. Going forward, Care Rating expects collection efficiency to remain high and close to pre-COVID levels, leading to further improvement in asset quality metrics. Key risk factors. We anticipate the growth momentum to continue for the NBFC MFI sector. However, some key risk factors need to be closely monitored. Increasing indebtedness at the customer level, along with rising average ticket size, poses the risk of over-leveraging for the industry. As can be seen from the graph on the right side, average ticket size has increased from around 27,000 in financial year 19 to 42,000 in financial year 23. With disbursements further rising in the 40 to 50,000 category, we expect the industry average ticket size to further increase going forward. Also, considering the inherent nature of its asset class, NBFC MFIs are highly prone to event-based risk, such as political, geographical uncertainty, and susceptibility to natural calamities. Moreover, the evolving global macroeconomic environment and whether the support from impact funds and PE investors will continue at the same pace needs to be closely monitored. Also, the credit underwriting is seeing a fundamental change with shift from JLG to individual lending, and how NBFC MFIs are going to manage their growth along with credit quality needs to be seen. Evolving landscape. Co-lending. Co-lending is emerging as an important funding avenue, especially for the smaller NBFC MFIs, with tech-friendly entities getting a preference. Improving digitalization. NBFC MFIs have begun to adopt to new technology trends for faster loan origination, efficient customer services, and cashless transactions. This will lead to improvement in the overall efficiency and productivity in the system. Risk-based pricing. Risk-based pricing approach may provide base for increased use of analytics in the industry. Care Ratings outlook for the NBFC MFI sector. NBFC MFI industry is expected to continue the growing trend with growth rate of around 28% year-on-year in financial year 24. Asset quality is expected to improve with the gross NPA ratio expected to moderate to around 2% at end financial year 24. Return on average assets are expected to improve to around 3.8% in financial year 24, supported by controlled credit cost and improving NIMs. However, the industry continues to remain prone to any event-based risk. Moreover, rising customer indebtedness, geographical and political uncertainty continue to remain key monitorable factors. That's all from my side. Thank you. And now I would like to hand over the session to Mangesh.
Thank you, Neha. Now may I invite Sanjay Agarwal to take over the session, please. Sanjay is a senior director at CareEdge Ratings, has 3 decades of experience in the field of ratings, banking, and infrastructure finance. Currently heading the BFSI vertical of CareEdge Ratings. Prior to joining CareEdge, he had worked with ICICI Bank and IFCI. He has a bachelor's degree in commerce. He is a chartered accountant, also qualified as a grad CWA, a financial risk manager from GARP, USA, and as a certified financial planner from FPSB, India. Over to you.
Thanks, Mangesh. It's my pleasure to introduce our esteemed speakers, all of whom represent different aspects of the NBFC MFI business. At the outset, I would like to inform the audience that the speakers are present in our panel as industry experts and not as representatives of the respective organizations. Hence, none of the views expressed should be construed as views or information of their respective organizations. Further, we will not take up any organization or event-specific queries here. Let me begin in the alphabetical order. Our first panelist is New York-based Mr. Aleem Remtula. Aleem is the partner, head of private equity in Developing World Markets, or DWM. Aleem joined DWM private equity team in 2009 and has nearly 2 decades of experience with socially responsible double and triple bottom line venture capital and private equity funds in US and Europe. Our next panelist is Mr. Chandramouli Vemuru. Mr. Chandramouli is the general manager in SIDBI, Mumbai. Mr. Chandramouli has over 30 years of experience in both private and public sector organizations in various geographies across India. He has been instrumental in helping scores of entrepreneurs and enterprises, whether budding, growing, expanding, diversifying, graduating, or excelling at whatever stage and with diverse requirements. We also have with us Mr. Manoj Kumar Nambiar. Mr. Nambiar is the managing director and board member of Kolkata-based Arohan Financial Services Limited, a leading MFI. He is the vice chairman of the Group Executive Council at Avishkar, the holding company. Mr. Nambiar has served in the governing board of MFin, the microfinance SRO, for 6 years from 2013, including as its president from July 2015 to June 2016, and then as chairman twice from July 2019 to June 2021. And he is currently the lead of the steering committee of 37 MFI lenders in Assam, liaising with state government on the Assam Microfinance Incentive and Relief Scheme 2021. Our next panelist is Mr. Vineet Chattree. Vineet is the managing director of Mumbai-based Svatantra Microfinance Private Limited, which is one of the largest MFIs of India. Vineet has a rich experience of 25 years across operations and management consulting in India, US, and Middle East. He is on the board of both Svatantra Microfinance Private Limited and Svatantra Micro Housing Finance Corporation. He also has served on the board of MFin. Again, I would like to remind the audience that the speakers present in our panel are as industry experts and not as representatives of their organizations. Hence, none of the views expressed should be construed as views or information of the respective organizations. Further, we will not take up any company, firm, or event-specific queries out here. I begin the session with Mr. Vineet Chattree of Svatantra. Sir, the liberalization of pricing caps has allowed the NBFC MFIs to go for risk-based pricing. How do you think is it going to shape up the microfinance industry?
Yeah. Thank you, Sanjay. And I thought my name starts with V and I would be last, but I'm happy you took the reverse order. So, before I come to pricing, and that's a very relevant question, let me take a step back. And I must say that the microfinance regulations which have come in, specifically, while on one hand, people talk about it creates a level playing field, but if you dig deeper into the regulations, it's a very clear indication of the recognition of regulators about the maturity of that sector. That's point one. Second, it is going to enable a deeper reach, and that reach will be actually viable to extend the whole agenda of financial inclusion in this country, right? And importantly, this viable reach will be uniquely differentiated because of the risk-based pricing that will be adopted. And last but not the least, it will actually encourage a fair amount of entrepreneurial ventures in this sector. Let's be honest that, microfinance while on one hand is as important as a financial institution, but it's absolutely important to understand that we have a huge social perspective when we operate in this sector. And this regulation is actually going to balance this approach. So that's a very important dimension of the regulation as RBI has created in terms of creating this as an asset-based regulation. Now, coming to the point that you mentioned, it's very important to understand that the risk-based pricing is not only important for the viability of of us and on one hand, but it's also important for the maturity of customers in this segment. It's only on one hand that the customers have to understand that the behavior in the whole credit dimension, and by the way, we as a country need to go a long way to create a fair amount of credit discipline, and in fact, in a way of also creating GDP growth based upon credit, we are in fact lower on that ratio compared to many of the developed countries. It's important to educate the customer about the way the credit eventually impacts them on the pricing. So therefore, I would say that this risk-based pricing approach is going to actually enable that element of discipline, which will go a long way in creating them as a mature borrowers as they evolve. And eventually, we believe from microfinance to mainframe borrowers over a long term. And also, on the other hand, it helps us as entities to differentiate our products. Differentiate our products not only from just a microfinance product perspective, but also probably take these customers to the next level. Because by the way, in this regulation, there is an element of diversity which has also been allowed by the regulators to a larger extent. And this risk-based assessment, which is the fundamental aspect, is going to help us take them to the next level as we all graduate them from microfinance to microfinance plus kind of products. So I would say all in all, it's important to look at both sides of the coin. And I'm in fact, as an operator, as a member of this whole microfinance institution, it's actually a great move. And we would rather probably applaud the effort of the regulators in creating this regulation, which is actually absolutely beneficial in the long run.
Okay, so your take is that while it will help the government in its objectives of financial inclusion and extending that, it would help the borrowers understand credit and be ready for the next level of business, as well as it will help the microfinance entities put in more, let's say, capital or do business, since it allows them a fair pricing. Right. So now we turn to Mr. Manoj Nambiar of Arohan. So with income assessment now moving from individual to family level and pricing caps being removed, has the focus on credit underwriting undergone a change?
Thank you, Sanjay, for this question, and thank you for the opportunity. I'll add on to what Vineet said, that the change in regulations from 1st of April 2022 has been a paradigm shift. And why I say that is not as much on the pricing front, as much on the credit guidelines. Credit harmonization for a very sensitive constituency that we all deal with is extremely important. And to that extent, the whole concept of household income assessment through various questions which are asked, because there are no documents or various salary slips that you can depend on. And the fact that you cannot leverage the family more than 50% of their monthly household income is extremely important. This is probably the only asset class where the regulator is actually telling you how credit has to be administered. So to that extent, I would say the slight uptick in the delinquency that we all saw in the sector before COVID, of course, the whole COVID period was extremely different in terms of the presentation that we saw, and the tapering off that we see today. I would say, given about 18 to 24 months from the time that the regulations took place from 1st of April 2022, I would say in about 18 to 24 months time, when the entire portfolio churns out and then sort of becomes, sort of eligible for renewal, you will have two important things coming up in the credit bureau. One is the fact that the household income assessed by one lender whose loan has come up for renewal will be visible to the other lender. So I cannot have a situation where, let's say, my loan officer goes and evaluates somebody at maybe 1.5 lakh, while somebody else has actually evaluated her at about 1 lakh rupees. 5-10% difference here and there is understandable. right? So I think for the first time, you will see if there are 2, 3, or 4 lenders who are dealing with a particular customer, there's an automatic sort of uniformity or pressure being built in terms of ensuring that the range of the income assessment cannot be beyond a certain point. That is one. Second is the most important thing, which is the 50% FOIR. So amongst all the reported credit outstandings in the bureau, right, the monthly installments that the customer has to pay out, including the new loan that you are considering the customer for, cannot be more than 50%. These two changes, which have started getting implemented from 1st of April, I would say by the end of this financial year, when the entire portfolio has been completely repopulated with this data, will herald a very different asset class in the country going forward. So my own prediction is that by 24-25 onwards, you will actually see lowering of delinquency. You will actually see lower provisions and credit costs, even compared to pre-demonetization days. Demonetization and then COVID essentially were the two things which changed the whole sort of group culture, discipline, and payment. So I would sort of summarize, Sanjay, by saying rather than making the credit assessment sort of loose, it has actually made it tighter. The fact that only 30 or 40% of the industry were being subjected to not more than through lenders, not more than 1,25,000 outstanding, in terms of the first loan that you could give, all of that. Today, the entire 100% of the sector essentially is following that. So this is a very, very important sort of change, apart from the pricing, which has been discussed earlier, where we are allowed now to price for cost and risk. And for the first time, you will have a situation in the sector that in the same group, you could have customers who probably are getting the lowest rates and probably a new to credit customer who's being charged slightly higher, given the fact that she still has to prove her credibility.
Right. So I still remember early days of Mr. Vaishnav Malikam, who was also our rating committee chairman. So
Right.
from there to now, the industry maturity has gone multifold, and I think that is also being reflected by the way regulators have been treating us and dealing with us. So when they started with the pricing cap, and now they remove the pricing cap, and then they've harmonized across various organizations. So I think, as you said, it is the maturity of the industry which is now being recognized by the regulators. So coming on to the financing, Mr. Chandramouli Vimuru of SIDBI. Sir, over the past few years, we have witnessed an increase in the average ticket size, which again was brought out in a slide. So do you consider it as a key risk factor, and how do you think it could be addressed? Sir, you are on mute right now. So you are unmuted, but yeah, right.
Yes, correctly. Average ticket size has been on the rise, and the percentage of the ticket which was 24 to 28,000, which was having a higher bracket earlier, has reduced, and we are observing from our own data that it is more in the 40,000 plus disbursement tickets which we are observing, and average exposure per borrower in the MFI space has also gone up to 50,000 plus. If you see, and in the MFI universe also, the NBFC MFIs have taken a big lead and they have taken it forth. Banks, I saw the average ticket size about 42,000. SFBs are highest at 49,000. NBFCs were much higher, maybe is almost at that range. So if you see, the reasonable ticket size increase is expected. We cannot looking at the inflationary factors and ability to the beneficiaries to acquire any reasonable utility asset or anything, a reasonable ticket size accounting for the inflation factor is not totally an anathema, definitely not. In fact, my own experience tells, if be it MSME or the micro, underfinancing is more riskier than not providing a reasonable ticket to anybody. That is not the correct way of looking at it. So by reasonably adjusting the inflation factors so that the average tickets are at sustainable levels, coupled with what was told earlier, that maturing of the borrower who has completed 1 or 2 cycles And then we saw that the credit risk factor has lessened for the particular borrower or the group, and the willingness of the lender to give a higher ticket is very much in order, and it will enable to them, the borrower, to buy a reasonable tangible asset or a incur an expenditure. Supposing a borrower wants to construct a small room also, the costs are quite high, and our finance should be enable them to achieve that. Otherwise, if we don't do, they go somewhere and the indebtedness will increase. The loan should come from one source reasonably. It has to be reasonable, and the ticket size increase, it cannot be taken as a risk factor totally. Moreover, the mature borrowers, good borrowers, they're moderating the tenors to adjust to these ticket requirements. The tenors are suitably increased within the space, and the regulator has also, as long as we are within the regulator space, who have told that the outflows of repayment of monthly obligations to be capped to 50% of household income. If we keep that in order, then a reasonable ticket size is okay. Maybe from credit analyst point of view, you may find certain risk, and as a development banker, to take care of the need of the really BOP, reasonable ticket size, I don't find it's really a huge risk factor, as long as mature thought is going ahead. I feel it's okay. That is my take on this.
Okay. So you feel it's not a very big risk, provided the counters and the guidelines are followed in right spirit and letter.
Yes.
Okay. So coming to Aleem, Remtula of developing world markets, which digitalization, individual credit underwriting, risk-based pricing, and cashless collections, will MFI business model end up being similar to that of unsecured personal lenders? What is your take on that?
Yeah, thanks, Sanjay, and thanks for allowing me to be on this esteemed panel with a few friends and colleagues in the space. So, I think this is really a critical question. But maybe jumping off of Mr. Chandramauli's point kind of earlier, I think there was a article maybe penned a month ago by Samit Ghosh, who kind of made a very clear point that microfinance portfolios over the last decade or so, since 2012, have grown 10x, but the actual borrower growth over that same period has been 2x. So certainly we can't ignore kind of the progression, and we've seen that progression in our own portfolio. Today, DWM has around 100 million outstanding in debt and equity across 10 names, so roughly comprising 15% of our global portfolio, which reaches across 60 countries. And I think this is a conversation that's kind of happening globally, that there has been a progression as financial institutions and inclusive financial institutions are graduating with their borrowers to higher tickets. Some are crossing over into the unsecured kind of individual loan segment with varying degrees of success. But I think for the most part, and I would say at least in our portfolio this is true, the underlying customer acquisition channels, the underlying kind of underwriting capabilities of those businesses, the servicing elements of those business models, with some new process efficiencies being introduced, remain fairly consistent with our microfinance roots. So those individual loans that have been extended have largely been to later cycle borrowers graduating from the JLG activities. The underwriting has largely been, and maybe even inextricably linked in some cases, tied to their repayment history and based on a simple rules engine that has been applied. I think a true shift in the model to a true kind of unsecured lending model, I think would entail, it's still a few years away, and I think would still entail maybe two basic kind of premises here that I don't think have yet fully been recognized, maybe with the exception of present company, but an understanding of product agnostic delivery of credit. So underwriting that is agnostic of the product through which the credit is delivered, whether it's personal loans, installment loans, POS financing, credit cards, like that underwriting is product agnostic. And then I think the second piece is we've been talking a lot about risk-based pricing. I think that building the capabilities for risk-based underwriting, or underwriting based on cash flow characteristics of that underlying kind of constituent, rather than just applying a simple rules engine, to later cycle borrowers, assessing credit and repayment capacity based on a better understanding of business and or project cash flows, I think is going to be critical. And I haven't seen those emerge. And so at least the gap between where we are now and a true kind of unsecured, kind of lending model, I think is still kind of, there's still a gap that needs to be filled.
So right, Aleem, I think we again are discussing the maturity aspect, while our earlier speakers had said that the industry has matured a lot, and that is what is reflected in the way regulators have been dealing with the guideline. But you see that needing to move much ahead, in the sense that it should be, let's say, the underlying purpose should be, the assessment should be purpose agnostic, and it should be cash flow based. And so there's a long way to go, but this obviously is a good direction in that you have the risk-based pricing already starting out here. So that's a very good observation. So now we move to Mr. Chandramouli. Again, do we see from a let's say development finance body, do we see more prominence for individual credit underwriting as compared to the reliance on societal adherence, which was the basis of this industry?
Yeah, I will come to that. On my previous point, what I was again telling was the ticket size is increasing to enable them to get a reasonable asset, and their inflows also will increase. Inflationary factors will increase their cash flows also, probably. Means it will correct itself. We're not telling throw the money, but they have to be reasonable to their requirements, just requirements. So as regards your present point about individual credit taking eminence, means again, I look from two angles. So the question is required to be looked to what we are aiming at and how the ecosystem has emerged and is emerging, both the things. So all these days, see, the business models are constructed based on the target, could be revisited as per the changing directions or the forces, how it is moving. The Indian microfinance sector itself has passed 30 years of 3 decades of sustained operations based on the joint lending societal aspects. This has taken it to this level, and it has developed a considerable gravitas in this field. The sector itself has emerged as a key player in touching the lives of economic bottom of the pyramid, and is recognized as a key financial inclusion tool. As a development banker, it is that aspect which is quite important. The sector has witnessed, weathered, and overcome several crises and has grown sustainability. All along, it has been the group level funding through JLG and SHG models and the societal aspects that has functioned as apt approach to reach the BOP borrowers. It acted as the best means to reach out to many, educate many, and also acted as a societal risk mitigant on both sides. Now, if we consider this, what has been achieved and where we are, there are still a lot of geographies in India where the microfinance group level funding holds preeminence still and continues to be an apt model. So the growth plans of many of the MFIs which I am seeing is based on reaching out to the new untapped geographies and demanding geographies where the current model will still hold good. But again, there is another angle which is emerging. At the same time, among the various positive impacts of the microfinance sector, it has been the growth of good number of beneficiaries economically moving up the ladder from being a group saver to an individual saver, and having individual understanding of how to utilize these loans. So the microfinance sector has mobilized various self-employment opportunities for the poor and last mile beneficiaries, and it has empowered them and trained them to travel up the ladder. Now they are in a position to, some of them, to take an individual loan. Now, if we keep that coupled with the new regulation of RBI and microfinance definition, where individual loan is perfectly enabled to be covered under the definition. Earlier, the thought was only it is a social model and joint lending model, but now individual is very much within this one. So the demand and the ability of the upwardly mobile beneficiaries who are willing and capable to avail the microfinance loans with the regulation enabled, catalyzed by the third dimension, which is the digital lending option, which is available at the doorstep of the loan seekers. This individual lending will be feasible. The digital lending models, and now what SIDBI is trying, the Udyam Connect platforms, will bring individual borrowers into the formal segment, which will make the dispensing of loans at individual levels more easier. The loans to micro entrepreneurs is emerging, and it will emerge. So what we have to keep in mind from regulator and development banker point of view is fair business practices requirements are adhered or not. It has to be seen whether these underwriting aspects are made quite simpler for the BOP level loan user to vividly understand the implications of the loan availment, whether customer protection aspects have been clearly taken care of. These are the aspects. The RBI regulations have put a special emphasis on customer protection methods, MFI lender staff itself well trained, loan recovery methods being very perfect. Why? Because we have seen the digital apps reaching out to the poorest people and exploiting them. So these aspects will become quite important, and whether the underwriting aspects are made, the beneficiaries are aware of those things. So while the JLG and SHG model group dynamics act as an important protection, in individual level, the borrower individual is exposed to various individual level responsibilities, and this segment is reaching out to the underprivileged, and the BOP has to be critically be noted. Once confidence levels increase with higher digital penetration happening, so individual level loan and underwriting will happen, and it will happen more in those who have graduated out above 1 lakh to 2 lakhs bracket within the MFI, 1 lakh to 5 lakh, where SIDBI's Prayas scheme is aiming at. So this aspect has to be taken with due care. Otherwise, we will be caught in a regulatory watch, and it has to be carefully done that the BOP customers are not exploited. I hope I'm communicating that.
Right. So I think that was very appropriate and very comprehensive way of putting things. So we had the earlier discussion on MFI plus, and now we are putting this discussion on Prayas. So I think, and Aleem had already said that we need to go product agnostic lending into more cash flow based lending and all that. So I think it's all the movement in that direction by the regulators. So we hope that the maturity, the industry mature, the regulator will be more and more willing to move ahead. So now coming to more on the semantics of the MFI business, the MFI microfinance industry has grown by about 37% in FY23. So Vineet, what was your view on sustainability of such high growth metrics?
Before I answer the growth rate has to be put in a perspective of, I would say, the landscape of this country. If I look at and there was a recent study done, in fact, at the MFIN by MFIB, there are 600 odd districts in this country. The penetration is touching about 300 odd approximately. We have yet to create the deep reach which is required to deepen the penetration of credit in this country yet. That's number one. Point number two is, in fact, there was another study done that the potential households which are actually microfinanceable, and when I say microfinanceable, is not about just dumping credit. The people who have not yet been reached deserve credit to create that sort of self-empowerment and come and join the bandwagon of a larger financial mainframe is actually 3 times of what the industry has today reached in terms of households. It just reached to about what, 6 crore borrowers? In fact, there are probably more than 3 times of the households which are yet to be reached. If I just put that into a perspective, in fact, this 30% is still actually not adequate in terms of reaching and creating the desired impact, which actually all of us, and I'm not wearing the cap of microfinance at this point in time, I'm looking at the point of view of financial inclusion or from a point of view of a credit, is yet to be done. So that's a big debate. So it's not about the growth rate. It's about the have we reached out and created that impact which is desired by the whole industry. And the reason why it was created, in fact, it was very interesting dimension that, and I'm sure Manoj here would know what I'm talking about, that when we go and talk to regulator, that, please give us a space to diversify. And rightly so, the regulator comes back and says, have you actually created that impact that you are designed to create before you start diversifying, right? So there is therefore a fair amount of potential to grow, and that puts in a perspective of the growth potential. But at the same time, I must also add an element of caution that it's not about the growth, it's about how you grow, right? And therefore, and I'm very pleased to say that even in the industry, when I see today, all the operators actually take pride in saying how many new to credit customers join them in their portfolio every year. Every month, for example, across the industry, across players you talk to them, at least about 25 to 30% new to credit customers join their first cycle bandwagon. And that's no means a small task. And when I say new to credit, it's not new to them. It's new to the entire financial ecosystem. This, in fact, reiterates the point that we are still reaching out to people who are yet to be reached, right? Yes, of course, if somebody wants to go and just keep on giving the loans to the same customers they have, that is something, of course, is one has to keep a watch upon and ideally not desirable, because as Mr. Molly was saying, that if you're just doing to the same customer a repeat loan, you might as well take them to a larger bandwagon. You actually take them to a different avatar. You actually take them to individual lending or a larger mainframe lending. But to come back to your question, has microfinance, is this growth unseemingly large? I would say it could be actually larger. I'll stop here.
Yeah, I was about to summarize and you have summarized it, that the growth actually could be larger, or is good to stay at this level. So I come to Mr. Nambiar, that with banks running high on NBFC exposure limits and NBFC MI5 is having high growth plans, is there sufficient debt funding available for the industry growth ambition?
No, I think, Sanjay, the points on growth, under-penetration, potential to sort of scale up, given the fact that the foundations on the credit bureau, the RBI regulations, all of that are in place. And I would also say that the IT infrastructure, given the fact that all of us understand that this is a multi-million sort of customer-based business, which also means that millions of transactions happen on a daily basis. So I would say the foundation in terms of the next phase of growth is certainly being laid. Now, coming to your point on the debt, I think one has to look at it from the fact that this is a very, very priority sector as far as the RBI and the government of India are concerned. And to that extent, the PSL benefits which accrue to lenders who lend to us is extremely important from ensuring that the credit is directed towards this particular sector. Apart from that, if you see, you've got off-balance sheet sources of funding, on-balance sheet sources of funding. There is domestic, there is overseas. So I would say if your company is well capitalized, it is well rated, you've got a decent set of management which is there in terms of corporate governance and all of that put together, I do not think that there is a problem in terms of funding today, right? Certainly, I would say even from the MFIN side, the smaller and medium sort of sized MFIs certainly have a little bit of a challenge. But there also, if the asset quality is good, if they're able to raise capital on an ongoing basis, and there is a little bit of a track record, it is quite possible to actually attract it. Yeah, I mean, I would also say that from an asset liability mismatch, please also appreciate that we borrow long and lend short. So to that extent, most of the funding which comes is 3 years, 4 years, 5 years, whereas the loans that we give can be as low as 12 months, 18 months, 24 months. So from an asset liability mismatch, where else can you get an asset class which in steady state has delivered a credit cost of less than 1%? Now, priority sector, asset class tested, right? The need for PSL and all that put together, all of that put together, there is enough funding sources. And I would say, I would look forward to the, time that at least the top 5 or the top 10 also start getting rated upwards so that they can actually access the capital market. So funding from the PSUs or the banking system is one, but over a period of time, one has to tap into the larger universe which is available in terms of debt.
Okay, so you think some part of the challenge come back to us that we should be rating NBFC MFIs at a higher level so that they would go to the capital markets. I think
I guess we have delivered our message.
I think Sanjay, this is an asset class. It's an unsecured asset class, which in good times has shown a credit cost of less than 1%. And I think just because of a lot of the other risk factors that you all talk about, we have been suppressed in terms of rating, which is very, very sad.
okay. No, so certainly I think it's a part of the maturity of the industry as we've been discussing all along. So, and again, we come to Mr. Chandramouli. So, do you think co-lending is a sustainable business model for MFI?
See, co-lending is emerging as one attractive tool. Whether it is sustainable itself has to be looked at from multiple sides. See, what's the advantage of the co-lending okay, it may preserve the capital for the MFI or something, but the main advantage is the blended rate being softer on the borrower. So at this stage, after the lending caps were removed, the landed rates for the MFI sector has not come down. It has increased, and the sector is absorbing it. Unlike I have been in the MSME segment, MSME segment is still again it becomes very competitive there. This MFI sector, to be fair to it, it is absorbing that. Given that alternatives are much more costlier and the ecosystem adjusts to that. So as such, I observe that for the MFI beneficiary point of view, there is immediately no interest accruing by way of co-lending or other aspect. Now, the main thing is between the MFI lender and the co-lending partner. So probably in a typical BC model, MFI lender may be doing the similar thing, but the GST aspects and other things have become cumbersome, and they find, okay, co-lending will be a better option. And a co-lending partner will find that, okay, higher skin in the game is a better option. Both will find a synergy there. Probably co-lending will become an attraction. But if you see, we are observing the priority sector benefits are pushing beneficial consolidation and in-house merger of performing entities. So where is the question of co-lending? You are budging, certain people are going into that. So again, now what is happening, this qualifying asset has become an important aspect. How much I have to keep my qualifying asset in the book. So the co-lending can at best happen in the 25% space where you can do the incremental individual lending and other things, where it helps you to get a better margin and a reasonable space for the co-lender to also participate. As long as the MFI space, given the constraints, probably it be better they keep it in-house and do. That's my take. I think the captains can add to that. So it is a good opportunity available, and still it is emerging in the MSME space itself. It has not fully occupied this entire space. Still is emerging, and all these things we have to be ready, because tomorrow these changes will come very fast on us, and we should be prepared. That's the best thing we have to be prepared for. That's my take.
Right. So you're saying right now probably this space is probably less suited for co-lending compared to other spaces, while But the readiness need to be there, and people are ready in some sense, but probably the other benefits from not going for co-lending than for going for co-lending. But yeah, I mean, the people are ready for that. So now coming to the question, so either Vineet or Nambiar sir, any one of you can take it. Why is there increased exposure in states like Bihar, Tamil Nadu, UP? How is the borrower behavior in these states different from those of other states? So probably Mr.
See,
Nambiar would take it.
yeah, no, so I would say that, please appreciate that at the end of the day for a lender, it is important as to how the population, the customers react in terms of repayment. Right. One. Second is what is the potential available there from a population density and credit requirement perspective. So to that extent, you will find states like West Bengal, Tamil Nadu, Bihar, right? Especially the ones which have shown excellent repayment record even after the pandemic. For example, Bihar, and this is exactly the reason why. I mean, I remember in 2010 when we started our operations in Bihar, the market penetration was in low single digits. Today, I can say that at least it is crossed that 15, 20, and it has reached a level where one can say that microfinance is available. Right? I think it is also reflective, Sanjay, of the coverage of the formal banking system, right, and the fact that formal credit is probably not available to the extent that it should be, and which is the reason why the non-banks like us are able to see potential and actually move. Now, in terms of the slide that we saw earlier, the share of NBFC MFIs earlier was hardly about 20-25%. It is moved from there to 30, 35, and now around 40%. So that itself shows you that the nimbleness, the speed with which we can take decisions, expand, open branches, devise products, make the changes which were made by the RBI from 1st of April, you would be surprised most of the NBFCs would actually implement that in the first quarter itself. Whereas I'm sure with the extra compliance requirements and the rigor on the IT system and all that which was required, the banking system took slightly longer. And that is the reason why you see that we've reached almost that 40%. So states which have potential, which have performed well, obviously will attract more attention in terms of people moving there, opening branches, and expanding their lending. But over a period of time, I mean, when we say 350,000 crores, we still say that it is hardly about 30% penetrated. So where is the remaining 70%? Right? The remaining 70%, maybe 50% of that are depending on informal sources, which are not formally regulated. And that is the reason why the government of India and the RBI essentially want formal credit to be available to this, basically this section of society. And which is why you will find, like Vineet said, with the pricing freedom that we have now on cost and risk, you will suddenly see a lot of the geographies where the population density is not very high, where the operating expenses would be slightly higher, would actually get covered. So this is a legacy, I would say, of that 10% regime in terms of the margin which was there, where people tried to look at states where the density was good, where the operational efficiency could be high because of the 10% margin. Which that getting relaxed, you will find growth now will span across the other geographies which have not been fully covered.
Right. So you're saying that.
Yeah, and just one point to add to what Manoj said, absolutely right on density, credit quality, pandemic, post-pandemic behavior, and the nimble-footedness of microfinance. One must also appreciate that microfinance addresses the requirement of customer at their doorstep. Compared to formal finance where they have to walk in and understand the credit, we are the ones who go to their doorstep and explain them. So you will see many more sections. I mean, eventually in the eastern states where the penetrations were traditionally low is where the adoption of microfinance is also higher by the customer. Because of the way we operate, it is very different and it's a very physical, trust-oriented methodology. So it's a dual side thing. It's not just that we go and therefore do it. It's that they want and welcome us, and that's why we do it.
Okay. So you're saying one is that with pricing, the business can support a higher OPEX, and hence it can go to districts which are underserved because of, let's say, the OPEX related issues. The other thing is that because of we are also looking at states which are under-delivered in terms of normal credit otherwise, so microfinance does play its part. And The interesting message is that now probably banks would be able to catch up with the new delivery system under the RBI regulation, and hence they could catch up on speed in terms of growth compared to what we have seen till now. So interesting takes out here. So I would now turn over to Aleem, that we have seen so much of growth being discussed out here. So, but with the global turmoil and equity markets and then impact funds, PE investors and all, what impact could it have on the growth of the industry in terms of equity financing? What is your take on that?
Yeah, that's sort of the million dollar question, isn't it? I think from our perspective, at least, we've been active in India for last 15 to 20 years, and I think there's a quote attributed to maybe Seth Klarman, right? The values, the value investor, that markets are really a story of cycles, and so we've tried to be responsive but not overreact, and India certainly has been part and parcel of that, right? I mean, prior to COVID, you had DMON, you had AP, all of the elements that Mr. Molly was talking about. I mean, right now, I think we've become habituated to managing interim stress from any number of different issues. So certainly we'll see a cycle and an upswing. I mean, we're already seeing it from Neha's slides, but I think one of the pieces that I would want to make sure we reflect on that uptick in new equity investment coming into the space is I actually don't think that's new. That's deferred investments or deferred investment decisions that have been in the mix for the last 2 years that have not actually been enacted. And so certainly the capital raise cycle and process and exit activity and all of that has it's there, but it's slowed. It's certainly been a buyer's market from valuation standpoint, rather than selling into a weak market. Valuations at 20 to 30% below where GPs would consider reasonable. Investors have chosen to hold off on new capital rounds. Investors have, with dry powder, probably taken their time deploying and are looking to bridge their own portfolio companies so as to avoid any substantial markdowns that may not be necessary based on the underlying fundamentals of the business. So that gap between buyer and seller expectations on valuations will inevitably need to converge. Our own expectation is that portfolio company pressure on growth and also on the other side, LP pressure for liquidity will likely come ahead of a full recovery on valuation. So for us, that means that it's likely to be a buyer's market for some time, but we will see the picking up substantially, and I think what we're seeing is there are strong fundamentals, but kind of assets in our space seem to continue as among the most mispriced assets, right? With deep discounts to historical values. Most of our banks are clocking 200 to 300 basis points higher in terms of ROEs, but valuations much lower than what's been there historically. Having said that, I don't think it's all negative. I think there has been, as maybe my colleagues on the panel will attest, Manoj and Vineet in particular, there has been a flight to quality for investors, and I think there is been a heavier focus in the recent past on just more moderated valuations, right? So if existing investors are willing to accept that kind of that downtick in value, I think it does lead in the forward-looking period to better alignment and maybe more reasonable and sustainable growth rates expected going forward, which will address one of the issues that I think has plagued the microfinance investing space in India for some time. Is just kind of misaligned pricing expectations and growth expectations between your investor group and maybe the kind of on the operating side. I would just add maybe two other elements is, I think, Vineet said it's not about just, how much you grow, but it's about how you grow. And I think we're seeing a lot more of those, customer protection, protections being introduced, the CPPs being adhered to. I think 80% of our portfolio just in the last 24 months has added data security and data protection officers to kind of that senior kind of cater of individuals. And, whereas earlier the conversation was only about financial access, we've now transitioned post-COVID to a much deeper discussion about financial, resilience, and all of that is possible with, a bit more time to reflect and not always be thinking about, growth rates to accommodate, 5x, 6x valuations, but a more moderated growth aspect to be able to, accommodate the how you grow equally around, how much you grow.
Yeah, Aleem, I think that was a great answer. So the tussle between the buyer and the seller, I think it continues, and especially in FY 18-19, we had seen quite a lot of equity infusion, which took care of a lot of this higher leverage which was there, and leverages had moderated significantly. And that is why, if you see the COVID period, and that was the assessment even in, let's say, May 2020 or June 2020, that the sector has improved significantly both in terms of liquidity and in terms of leverage. And that is what enabled the sector to pass through the crisis, not depending on fresh funding to be raised at that point of time when funding simply was not available. So, and Neha had pointed out that a leverage of 4 seems more reasonable. The sector is there today, and it's growing at a high profitability. So, some part of the equity contribution should come out of the profits. Certainly, the industry probably would like to continue to raise capital, but I think we are at an interesting phase after 4 or 5 years of continuous issues. We now have 1.5 to 2 years of good growth being available. So that should give comfort, quite a lot of comfort to the industry as a whole. So we have a very interesting question. So probably one of the two microfinance entities they can answer. What is your view on AP and Telangana in terms of MFI AUM in the medium term, given the recent High Court verdict? I think that's one very watched space.
No, I guess, Manoj, I mean, if I can, just
Yeah, go ahead.
say, so by the way, just correction, it's a Supreme Court verdict, right? So one thing we must welcome, that now with the intervention of the highest legal authority, it is obviously very clear that the intervention in the RBI regulated entity through state and the state related aspects have to be, are to a large extent would be taken care of. So that's a one side, it offsets the risk that one would have seen in the past. However, at the same time, we must all acknowledge that the entry in Telangana and Andhra has already started. There are many microfinance entities, there are many banks, there are many SFBs who have already started entering into the state again. And in fact, as we all speak, that is one area. See, let's understand, we are not against, there are always borrowers, as we say, and there are borrowers who need this kind of a credit and need to come and join the larger bandwagon. It's only that anything that intervenes in this whole process of us and the borrower only results in the decline of credit discipline. I guess a lot of people don't understand that part. They think that they are protecting customer. I would rather say, on the other hand, the interventions from the third party actually disrupts the credit discipline and the trust that we take a long many months to establish. And to recoup that trust and discipline, believe us, it's not very easy. And that's what many people don't understand, that in their short-term gains, what they're sacrificing is the long-term benefit both to us and the borrowers. And this point needs to go very strongly across the entire ecosystem, right? And it eventually harms. It's never a win. So I would say that we all are keen to go back. In fact, the entry has started, and we welcome the decisions of Supreme Court in that direction. I mean, Manoj, yours.
No, absolutely. I think the High Court judgment in the AP and the Telangana issue, and the Supreme Court judgment that Vineet mentioned on the Money Lending Act applicability, I think takes away, if you ask me, one of the remaining risks which has been always been spoken about from a political basis. Having said this, I think now the sort of lay of the land is very clear that the licensor regulates. Right? So if you are an RBI regulated institution and you've got your license from the RBI, then you are essentially covered by the RBI guidelines and the regulation. If the state has licensed institutions like societies, trusts, cooperatives, then that is the set of institutions that they would directly regulate. Now comes the question, what if the state has a particular complaint against a particular bank or an NBS? Well, they're supposed to reach out to the RBI with the sort of details and essentially complain to them. And the RBI anyway has a very detailed audit process which happens on a yearly basis. There is an SSM which essentially handles most of the bigger institutions on a one-to-one basis. And to that extent, there is a fair amount of oversight and working together with the institution. So I think the long and short answer to the question is, we're very happy that these two states which got deprived of formal credit for almost 11 to 12 years essentially is opening up. We are taking very, very careful steps because down the line, it again means a change of mind. So whether it's the local administration or the customers, the news has to seep in, and they have already realized that in the last 10 to 12 years, instead of accessing formal credit, they have been forced to go to informal credit, and at times 10 times more expensive than what we would normally charge. So I think at the end of the day, like Vineet said, most of these interventions lead to a difficult situation for the most vulnerable segment, which is the customer. The lenders will take a hit and move out, right? But the person who really loses out essentially is that vulnerable segment, which then has no other option but to go to informal sources at much opaque terms and much higher rates.
Mangesh, means we have significantly run out of time. Probably we can take 1-2 questions. You can announce to the participants if they want to put in any question.
Sure, sir. So dear participants, we have taken the questions, but if you still want, we can just add your questions to the panel. So, sir, you want to take few more questions now, or should we conclude the session?
No, so probably we'll take one more question again for Mr. Nambiar. Means we've seen high inflation and elevated interest rates, and ticket size have increased. And also, how do you see credit costs going forward?
No, I think I've already answered that. Had the RBI credit harmonization not happened, right, I would certainly have that as a concern, given the fact that overlending could happen, and essentially the need for credit is definitely there. Even during the COVID pandemic and after that, given the fact that livelihoods have got impacted, savings have got depleted, the need for credit was very high. But then how would you assess that through the household income? To what extent would you lever the family is really what we were working on. And to that extent, the RBI guidelines essentially give us that sort of platform. One has to be careful in this segment, given the fact that it is unsecured. There is pretty much very little that you can do if you have lent to a wrong customer. And we are all very, very cognizant of the geographies which have slightly got, in terms of higher levels of credit. There are issues like ringleaders which play in geographies where customers essentially get sort of shepherded by people who basically help them get credit. So to that extent, I would say each of us as practitioners have our own credit risk and audit parameters which we seek to use in the expansion that we do. Right? At the end of the day, money is ours, right? Even if, let's say, a customer doesn't pay, we obviously have to pay from the banks or the lenders that we have borrowed from. To that extent, liquidity, the credit policies that we follow from individual companies then becomes extremely important. And I would say and it is being done now, one obviously would need to sort of do that added push from the SRO side on implementation of the household income assessment and the FOIR at 50%. If that happens, let me assure you that we are in for a moderation of credit costs and getting it back to even levels lower than pre-COVID.
Okay, that would be great. So one last question to Mr. Chandramouli. So how would this BC partnership with the banks and institutions, would it grow, decline? What is your take on that?
It will grow depending upon certain geographies. That's what I'm seeing. Certain geographies are more prone to more BC models and amenability. And again, the off-balance sheet or on-balance sheet comfort of the MFIs. These are smaller MFIs may prefer more a BC model. That's what my take into this is. And certain geographies, they may more amenable. They may not be getting regular credit lines. That the capital may not be very high. Probably they are more looking into the BC systems. That's what I have, as an observer, I'm telling this.
No, I think look at it like this, Sanjay, that a normal lender needs a capital adequacy of 15%, right? If you're a BC and if you have negotiated a decent 5% FLDG, then that is really the money of yours which is getting locked in, right? As long as the arrangement between the principal and the BC essentially has been well thought out after due diligence, then this gives the smaller entities, the medium-sized entities, some breathing space before they can essentially show some track record and be able to raise capital. Raising capital, like Aleem said, is today not as easy as it used to be earlier, right? The company has to be of a certain size, rating, management, bandwidth, the due diligence that we go through in terms of the portfolio, the financials. We're already on ECL, so we are taking higher financials, corporate governance, your growth plans, the geographies in which you operate. All of them play an important part in terms of the capital raise. So given the fact that only 30% is penetrated, a lot of these institutions, smaller ones, and all of us started from zero. Right? So all of us have been small before we became medium and then large. So to that extent, this is a breathing space available for all of them to at least move forward in terms of preparing a track.
Great, so thank you very much for this answer. So I'm getting quite a lot of questions on consolidation and on state-specific credit issues, etc. So given the sensitivity of the whole thing, we'll avoid all of them. And I think we'll now end this session. We thank everybody, Mr. Nambiar, Mr. Chandramouli, Mr. Vineet, and Aleem, all of you for taking time out of your busy schedule and participating in this webinar. And I would like to hand over the control back to our corporate communications team to take it ahead.
Thank you.
Thank you, Sanjay, for moderating the session, and Neha for your presentation. Thank you again to all our guest speakers for their insightful views. It was a privilege to host you. And thank you to all the participants for taking the time out and being a part of the CareEdge webinar. For any further queries, feedback, or suggestions, please write to us at corp.com@careedge.in. Goodbye for now. I request the tech team